Hello everyone. Welcome back to Finance Central. So guys, whenever we speak about the stock market, we always find two types of people. On one hand, there will be people who will say that you can earn 5 to 10,000 rupees every day. And then you have those people who will say that you can earn in crores if you hold stocks for a long time. Which means that you can either trade in the stock market or you can do a long-term investment. So which one is better? Trading or investing? Where can you earn more money by taking the least amount of risk? This is the very question we will address in this video in a very simple logical way. Because our aim is to increase your knowledge, motivation and direction. And that is what you will get by the end of this video. This will help you start your stock market journey without wasting any time. Your journey to financial freedom begins here. So let's begin. So this video has been divided into 3 parts. First, let us understand the concept of trading and investing in short. Second, we will understand the difference between the two. How these two types of people earn money. And where will you get that money from? And then we will understand which options works for you, by understanding the risk and reward in both options. So that after comparison, you can decide yourself as to which option is better for you. And at the end of the video, I will share my 2 cents as well. So make sure you watch the video till the end, without skipping any details. I guarantee you, that by the end of this video, you will learn how to earn money in one way or the other. So let us quickly understand both the strategies. In trading, whenever you purchase any asset, we usually do that with a mindset to sell. For example, stocks, futures, options, Bitcoin, or anything that you can buy and sell. And the difference in the buy and sell amount is the profit we earn. Some traders sell stocks within minutes of buying them. They make profits using the market fluctuations. The profits may be 1 or 2%, but they are usually big amounts. Now you may wonder how that is possible? We will understand that shortly with examples in detail. On the other hand, long-term investors only buy stocks. They don't buy any other contracts like these. They hold these stocks for a long time. 10 or 15 years, or even for a lifetime. The thought behind this is something like this. When a company does well, the price of the stock is bound to keep increasing. Because of which, in the long term, the stock price will always move upwards. However, the stock price can fluctuate up and down in the short term, because of temporary market sentiments. But in the long term, the stock price follows its actual value. Therefore, as the company grows, the long-term investors are also rewarded with profits. At this point, some of you may say, when we can earn profits on a daily basis with trading, why should we wait for the long term? Before we answer that, let us understand both these strategies in detail, understand the real differences using these 2 examples. Both these type of people, how do they actually earn money? And where does this money actually come from? In the first example, let us say you have a bet with your friend, by tossing a coin. If it comes out heads, he gives you 10,000 rupees. But, if it comes out tails, you will give him 10,000 rupees. And as soon you toss the coin, you cannot back out of the bet. The only outcome is, either you earn 10,000 rupees, or you lose 10,000 rupees. If you play this game only once, chances are you may get lucky and win. But if you play this game over and over again with your friend, do you think you can expect to be rewarded in crores by the end of it? At the end of the bet, your balance will either be plus 10,000 or a negative 10,000. So even if you play this game for a lifetime, there is a good possibility that you may end up going home empty-handed. Because, there are 50% chances for either of you to win. Maybe sometimes you win, or maybe sometimes he wins. This is why we call such a game a zero-sum game. Because you aren't adding any value to this. In the long term, this isn't benefiting either one of you. Neither you nor your friend, or the government or the society. Both of you are just wasting your time playing this game. Even then there are many who still play this game. Now after a few days of playing the game, a big problem arises, that is, whoever loses money, doesn't actually withdraw the money easily. They disappear as soon as they lose. Who likes giving money after they lose? And then we have the entry of the next person who says, you can deposit the money both of you have bet, in this box, put the money in before betting, so that no one can run. And for that a service charge of 1% will be levied for every time the coin is tossed. This man is popularly called a broker. And now we have the entry of the 4th person. He is that guy, who owns the place that you are playing in. He says to both of them that, whoever wins the game, pays 15% of their winnings to him, for using the house. The loser doesn't need to pay anything. Fair enough. Is what both of you say. Let's call this 4th person as the government. In a few months' time, you both start observing that none of you are earning much, but on the other hand, the broker is getting rich. And he keeps motivating you both to play, by feeding on your greed, by saying things like, "Look, this guy bought his dream car." In fact, after a while the broker himself earns so much money, that he begins to smartly invest it himself. To grow his business, market himself and find more people like the two of you. Once again, after a few more days, you notice something shocking, that after playing against each other, both of you have exhausted your money. Both of you are unable to understand how this happened. And that's when our fifth character enters. His name is Rocky, who explains that by paying a small fee every single time, you have transferred all your money little by little to the broker. In financial terms, we call this friction cost, or in simpler words, transaction cost. Now let's take a second example, where there are two people again. One of them does business, and the second person has a lot of money. The one who has the money, gives money to the businessman friend, thereby investing in his friend's business. Which makes this guy the investor, and let's call this guy an investor plus manager. The manager works very hard in his business and therefore continuously grows his business over time. He also gives back a part of his profits to his investor friend without fail, every year, by transferring the money directly to his bank account. We call this dividends. He also emails him a detailed report of the business, which shows how much profit he made, how he plans to grow his business in the future, and all other related information. We call this the annual report. Now the only problem here is, that the investor is not able to meet his businessman friend. Therefore, whenever this investor invests money, he uses the broker, and uses this box to deposit his money. This is where most of the people have their confusion. What exactly is this game, and how are people actually making money? On one hand you hear that a lot of money can be made here, and on the other hand you hear, that a lot of money can be lost here. I am sure from these two examples, you now have a clear idea, as to where people get their money, from trading or investing. Now let us come to the most interesting part of the video. And let us understand which option is actually beneficial, where you can earn more money, and which option has a higher risk. Let us take an example once again to understand this. Let's say, you have come home from work, and are talking to your friend on the phone. Your friend gives you a stock tip, saying buy this XYZ company, there is something big that is going to happen. And he gives you a proper explanation with logic, which convinces you, that the stock price is definitely going to go up. You get super excited, you go home and check the balance in your savings account. You notice that you have your emergency fund of 2 lakh rupees. Other amounts are locked in fixed deposits and PPF. You cannot touch those amounts at all. You check your entire house for other valuables, you find your wife's jewelry, but you know that you have a function on weekend and she would need the jewelry, so you make do with the 2 lakhs that you have. You see the stock price, and you notice that each stock is priced 20,000 rupees. You do a quick math and you realize, that you can only buy 10 shares of this particular stock. And that there is not much fun in buying just 10 stocks, because this is a guaranteed opportunity to become rich, and you don't get such opportunities again and again. Last time you got a tip was 2 years back. Suddenly, you remember that your friend was mentioning about margin facility and trading, and you decide that you will use the same margin facility. You call your broker, and he offers you a 50% margin. Which means that your profit will double because of this. You are so excited and cannot wait any longer. As soon as the market opens in the morning, you buy the stock and place the order. And wait patiently for the price to increase. At the moment your stock price is fluctuating around the buying price, and then suddenly you notice that instead of the stock price going up, it starts falling, and you are losing all your money, the whole market is trading lower. And you don't know what's happening. You call your broker friend to find out what's happening, but his phone number is unavailable. You then Google and within minutes you come to know why the market is falling. You notice that the President of the United States of America has tweeted saying, "I will make sure China pays the price," because of which all global markets have reacted negatively. And finally the market closes in 3% negative. You didn't end up selling your stocks, it automatically ended up getting sold because you opted for the margin facility. You ended up losing 12,000 in one day. China didn't pay the price yet, but you definitely did. You can't blame your friend here, so you blame the market instead. You end up thinking that the stock market is a gamble, and that you only make losses here. You promise to never enter the stock market again. The next day, the same stock rises by 5%. And on the other hand, 12,000 has been debited from your bank account. That evening you meet your old friend Rocky, and he tells you something interesting. When you try to understand trading closely, you realize that you need to be accurate about two things. First, what, the stock whose price is going to go up higher, which is your underlying bet. Second, when, the timing, when will the stock actually go up. To predict the when is almost close to impossible. This is what most people miss. This is also the biggest risk trading has. The concept of risk is very interesting, not only in investing but also in real life. We shall try to make a separate video on that, so do check it out when we upload it. So basically, in trading, if you get one out of the two things right, you will lose money. And the biggest danger in trading is that, when you go wrong, there is a huge chance of permanently losing your capital, forever. There is no concept of diversification, like buying 10 or 15 stocks, and neither there is hope for recovering the capital. And when you lose your capital, it is game over. Finally, let me share my 2 cents with you all. Whenever you trade and earn profits in the stock market, say a profit of 1 lakh, then on the other hand, somewhere in the country, someone has also lost 1 lakh. In this world, money is limited in the short term. It is literally possible to count the money in the entire world till date. That is a defined limited number. Therefore, while day trading, if you earn profits, it does not come out of the ground, and neither from thin air. It is a transaction that happens from one person to the other, after paying a transaction cost. In my honest opinion, there is nothing called as a part-time trader. You cannot expect to become rich by trading during your lunch break, by taking random tips from people, and expect to achieve financial freedom. The reason why most people lose money in trading is because they do this part-time, without experience, without knowledge, with limited capital, and compete against those who do this full-time, with a lot of experience, a lot of capital, and continuously learning and evolving. In the world of trading there is a rule, which we call the 90-90-90 rule. It means that 90% of the new traders lose 90% of their capital amount in the first 90 days. Now, when we talk about long-term investment, we can all become wealthy. As you see in this example, the investor becomes wealthy, the manager also become wealthy, and the standard of living also improves for every customer. It creates more job opportunities, the GDP of the country grows, and so does the economy. This is because, in the long term, money and opportunities both are unlimited. Else we would still be in the jungle hunting animals, instead of ordering food from Swiggy. There are many stocks in the stock market whose share price has grown multifolds in the last 10 to 15 years. 20 years ago, Sensex was at 4,000 points. And today it is over 48,000, which means in 20 years it had multiplied almost 10 to 12 times. And whoever invested in the stock market for long term, each one of them has successfully made profits too. And will continue to do so. This is because these people played a positive-sum game. At the same time they are enjoying the benefits of compounding. I will soon make a video on the benefits of compounding, and how compounding works. When you lose while trading, you don't just lose that capital, you also lose all the compounded gains that you could have got with long-term investing. We are not saying that you only lose while trading. You can also win, you can also become an expert in trading, use various strategies, etc. But if you aren't able to decide where you will be tomorrow when the market opens at 9:30 a.m., whether in front of your computer screen, or somewhere where you wish to be, then you must understand which way to take towards financial freedom. A lot of people dream of chilling, relaxing all day, or do something that they really love doing, and money can directly flow into their bank account, without doing any work, and at the same time the money keeps growing as well. This is something you can easily achieve by investing in the long term. Whether in stocks or any other form of investment, like perhaps real estate. But in real estate, you have to invest a large sum of money. Not many people can afford that. The process to collect rent every month is also tedious. While in the stock market, you can make smaller investments as well, and the money directly gets credited to your bank account, no matter which part of the world you live in. This is what we call real financial freedom. Lastly, those who try to become wealthy quickly. They keep trying forever, but eventually never end up getting there. But those who go about it the right way, their success is guaranteed, and now you know the secret to it as well. That by long-term investing everyone can become wealthy, and improve their standard of living. Actually, stock market has two sides to it, just like a coin, trading and investing, and I hope through this video you have gained better knowledge. This channel was started to spread financial awareness, so if you have gained any value from this video, then please do share this video with as many people as you can, before they lose all their capital in the stock market. And if you haven't liked and subscribed to the video, then please do so, and don't forget to hit the bell notification, so that you can be informed regularly when we post new videos. Do leave your comments below. If you have any queries, we will be happy to respond to each one of you. Thank you for watching the video. Goodbye.